I think a good place to start is, Giles, if you kick us off with right at the beginning and talk us through your kind of fundraising journey of Brandwatch and how it all started.
So I started a business in 2000 with a bunch of friends, which was an agency, really a tech agency. We built stuff for people, and we learned how to build software or how not to build it. And then in 2005, I got kind of sort of plateaued. It didn't really go anywhere. We didn't raise any money for it, so we didn't lose any money, but it wasn't really going anywhere. So I wanted to build a product company, start a product company. So I started off with this idea of, we built a search engine as part of that previous thing, or a web crawler. So I had this idea of turning search into a vertical thing for lawyers and bankers. We tried to do that, that didn't work. And then had this idea for Brandwatch where we would take this web crawler pointed at social media, basically. It wasn't called that back then. It was called like UGC, or consumer generated media. Things like blogs and forums and special interest sort of sites. Gather that data and allow brands or agencies, as it turned out in the early days, a view into what consumers were saying in all these sorts of spaces online, because they were sort of blind to it, and the conversations were happening there, and marketing was effectively happening without the brands knowing about it. So we called it Brandwatch. What brands need to watch what's going on when we're talking, and so they could listen and learn and serve their consumers more effectively. So we raised 2 seed rounds, £500,000, and then £600,000. So quite a lot, but we had to build this big back end data storage, and we had to buy servers at that point. AWS didn't exist, so there was a bit of a hardware kind of requirement. So we needed quite a lot of money, and we had no revenue, so it was quite intense. The first round, I pitched to a room a little bit like this, so 70 people in London Business Angel Network. About 10 were asleep, so hopefully I can't see you. So hopefully you're not asleep. And they managed to get about 200,000 from them, and then there was a fund, a government-backed fund called London Sea Capital. They matched all the angel funding, and my friend Arjo fortuitously had just sold his company, and so had some money to invest. And Arjo and a couple of the other early directors of iCrossing, Spannerworks that sold to iCrossing, they put in collectively about 100 grand. So we raised about £500,000, and that was 2006, I think it was, wasn't it? And then we raised another £500,000 about a year later. That was the early stage stuff.
Amazing, and it would be great to bring in Arjo here in terms of your perspective of writing that first check into Brandwatch. Tell us about that experience.
That last panel was really good, by the way, and I'm in awe of your professionalism, because I come from the other end of the spectrum, which is kind of self-taught, winged it. 2006, this morning I was just looking back and I searched for Brandwatch in my emails, sort of search all inboxes, and I came up with the original spec of the first bit of software from 2005. And so my investment thesis, that word didn't really exist for me at that time, was based on understanding digital at the time, if you like, or that the internet was going to be big. We were kind of start of Web 2. So there was a gut feel to it all. I hadn't exited then. I exited a year after I invested into you. So my first investment was persuading my wife to, put all of our savings into Giles's company. And I was just working out my personal balance sheet when I put 60k into Brandwatch, and my balance sheet was about 66k. As a family, that's probably what we had. But I believed the internet was going to be big. So contrary to the professionals that were on just before, it was one of those ones where I just drew a little flowchart this morning. God, why did I do it? And because everything's going to be big, right? You believe everything's going to work, and every founder's brilliant. And Giles was brilliant, and a very good leader, and a very good product man as well, and a good salesperson. But that wasn't really why I invested. It was more to do with the fact that I was running my own company, and I wanted a bit more of other things too, because you can't grow a company in every different area of your sector. So it was buying into another area that could be big as well. That was one thing. And the second thing was, and I know people go on about founders and who they are, but was also a trust thing about integrity. And that we kind of, Brighton's got a much bigger ecosystem now, but then I guess we all knew each other and we all knew we were kind of groundbreaking or trying to break ground. So it was a bit of that, buying into that as well. So completely amateur investment into a company that in the early days would be touch and go, I imagine. I remember you had servers in your office and stuff, and it was all, like cables on the floor, and hey, all good stuff starts like that. And then later on, things started getting a lot more interesting. Yeah, but early days was pretty amateur from my point of view.
Amazing. So it'd be great to talk through that journey of the various rounds and then getting to that exit, because I think we don't often have this opportunity to speak to the first angel and the founder. Now that we can talk about
Arjo told me just before this he had share certificate number 1.
Wow, fantastic. Yeah, amazing. I mean, it'd be great to hear. So what after that first check, so you've taken a punt on Brandwatch, put everything in it. What kind of happens after that? Are you raising again? Does Arjo get involved? And what was happening on your side?
So 2006, 2007 were those 2 rounds, and then I was like, okay, we've diluted quite a lot there. We need to prove. We were lucky to get. I was really lucky to get that second seed round done, to be honest, because we didn't have enough proof points really to make it happen.
What was that market like at the time when you were raising that of interest?
Well, it was pre-financial crash. It was 2007, but UK tech, not really. Back .com, there was still a .com hangover. In London in the 2000, 2001, that sort of 99, 2000, 2001, there were lots of crazy companies raising crazy money with silly names. And everybody just got washed out, even things like boo.com and stuff. So I don't think it wasn't super easy. And like the 70 angels that were in the room, 10 of whom were asleep, like they really weren't, I don't think they were really there. I don't know what they were there for, to be honest. But anyway, it wasn't easy. It wasn't easy to do. But the second round, a friend of mine, another friend who sold his business, put in 200,000. He sort of underpinned that one. And I can't remember if you followed on or not on that one. But we ran it for 3 years. We got to about 125 in MRR, and the back end was just falling apart. Like it was creaking like crazy. We were, harvesting all this data and trying to analyze it. And then we just got super lucky. Well, Durrance, this press clippings business, wanted to go digital. They wanted to bring in social media. They wanted to use our feed as part of their service. They wanted to resell the product. So they came to Brighton, stepped over the server wires, and said, we'd like to invest, and how much? And I was like, okay, and how much? And, well, we're thinking about $1 million. And I was like, okay, that sounds good. What valuation? So I quickly kind of said, well, 9 million. And they were like, okay, so what, 9 million post? No, pre. Totally make it. I said, but as long as you sign our existing shareholder agreement, because I could tell they were like super keen. And they were okay, fine. And then the money was in the bank 2 weeks later. I mean, it was ridiculous. I've never. That certainly didn't happen after that. But they did very well out of it, luckily. Well, more than luckily. I mean, it was great. Everybody did okay. So one of their guys sat on the board. That was just clean. Nobody followed on. I don't even think that. I mean, I must have offered preemption. I'm beginning to feel like I might be on the hook here, but I'm sure we did preemption. But anyway, that was $1 million in, and then we did a VC round in 2 years later. Well, that was November 10. February 12, we did our first VC round, which was a Spanish company that put in €4 million for us to go into the US, which we didn't even spend more than 100 grand of that. We got, the US thing, we got lucky. It sort of went really well. And then we raised 20 million a couple of years later, half of which was secondary, and a bunch of angels actually cashed out there. Arj didn't. Arj actually put more money in, but a lot of angels cashed out. And then final round was 33 million, all primary capital for like let's just push this really hard. And then we bought our biggest competitor and a couple of other companies, and then we sold it a few years later. But overall, I mean, it sounds like short, but that was a 14 and a half year journey. So to the point earlier on about, it takes 10 to 12 years, or I think that was the number RJ was saying in the back, I trusted you for 15 years, mate. I was like, yeah, thank you very much.
And Arjo, through that time, you followed on a few times, right? Tell us your thought process as he was doing each round and you deciding to follow on.
So through quite a lot of that, I was running an agency which was a people-based business largely. We had quite a bit of tech, but it was still a marketing agency. So that was exhausting me because you're managing a lot of people and it's very high-touch business and there isn't monthly recurring revenues, although we did have a bit of a business model around that. When I looked at Brandwatch, I thought, that's a bit of an easier business. Not that it was easy to run, but the actual business model itself was like, that's a business model that I aspired to build. So, yeah, we followed on as much as we could. I'm not sure about Durrance. I was looking through all the documents today and I saw where I followed on, and there's a paper trail somewhere, and every now and again it gets a bit lost. And there was one time we were on holiday, and I remember we were in Thailand and we were lying around the swimming pool and I had to get a document to Brandwatch signed by, I don't know, the next day or 2 days later or something like that. And my wife was like, why are you bothering? Just chill out, you're on holiday. I'm like, no, we've got to follow on here. We've got to, because it's going to go big. 15 years down the line, that conversation starts to, starts to play out in your head as well, because after 10, don't forget Google is decimating, for example, the web analytics sector, or a large part of it, because it launched Google Analytics, so not overnight, but it launched a great product for free. So I was always worried that some big changes by the hugest platforms would potentially wipe out the valuation of Brandwatch. Maybe not wipe the company out, but affect it a lot. But Giles was very smart in steering that. I think the communication is something we should talk about, because this is where your early reliance as an angel on the founder, I had access at that time. But then Giles gets really busy, right? And he's entertaining a much larger company, a company operating in multiple countries and with more heavyweight investors. And that's the time as an angel is really quite interesting, because if you're not in a syndicate and you don't have an investor on the board that is tasked with communicating to you, which we did but didn't really communicate. And I didn't really demand a lot either, but there were times when, 2 or 3 years would go by and I didn't really know what was going on. But I knew it was probably good, which is a lot of conviction. And then I followed on still. So I think we should talk about that sort of bit there, because the early stage of angel investing can be really exciting. And then you have a little idea, and you may have no idea, and you certainly have no control later on. Giles had a couple of angels that were very involved in the business as well, which we should also probably touch upon.
Yeah, that's such a good point. I think you hear a lot of angels saying that, that initial year, you kind of hear a lot from the founder, and then suddenly it kind of tapers off and they're focused on the VCs. So Giles, from your perspective, were you still communicating a lot with your first angels after a couple of years went by? Like, what was going on for you as a founder?
Well, normally when, and this is my experience being on the other side of it, when companies don't communicate, it's normally because it's always bad news, right? And for us, it was actually not. It was probably the other way, but I was just really bad at it. And I used to get a couple of angels that put in very small amounts, just hassling me the whole time. And I was polite, but I tried to get one of my like the CFO to do it, and he was doing a terrible job of doing that as well. So we really failed actually in our comms investor relations. I had 2 early angels that were on the board. One who sold out as soon as the first secretary came in, but the other guy was on the board all the way through. He sort of, RJ got to know him, and some of the other angels got to know him a little bit. But in general, we did a really poor job at communication. And yeah, I think an investor director, this guy should have been an investor director, really. He should have he could have taken on that. My view was, look, I'm going to build this company, and just let me get on with my job, and I'm going to make you loads of money. So I had this sort of silly thought process, but I really, we should have done better. And now I run a public company. We've got a whole investor relation team. So I do get how poor we were at that. Yeah, I would do it very differently.
And Giles, are you able to share what kind of the returns were for your investors from the ones that came in
I mean,
early?
it varied. The last money in was about 1.6, 1.7, so not great. And then I think the return on the first money in was like 30x. So I think your first 60K probably got a 30 times return, something like that. And then it declined to the last money in, not so much. But in general, apart from the last one, the others did all pretty well. The first VC, I think, made 10 or 15. The second VC made 3. The last one made 1.8, and the angels made the first round 30, and then declined if they carried on. So we sold it for $450 million, and we took in 60 in primary capital, or actually no, primary, I think less 13, 45 in primary capital.
Fantastic. And Arjus, obviously, I mean, a lot of angels take a different route on this. Like, do they follow on? And obviously, it depends how much conviction they have in the company, but also what their strategy is. How important was it for you, the follow-ons, in terms of getting that impactful return? If you just went in at the start, would it have been as fruitful for you? Any advice you give to people?
I averaged about across the journey. I think we averaged about 11 times on the investments. So yeah, the early bit when I didn't have money, and then I sold my business, so I had money to invest. I hate the idea of being diluted if you're onto a good thing. And that's really quite difficult, because if the valuation's gone up a lot, and if the round is big, and you're hanging in there with your few percent or whatever it is, it can be quite a significant follow-on. And you think, I started this thing on a wing and a prayer, and then I put a bit more in, and now I'm going to end up with hundreds of thousands in this company. But I just hated the idea of being diluted. I wanted to keep my percentage the same as much as I could. So apart from 1 or 2 rounds, or 1 round, I think I kept it the same. And that was more of a thing that this is, in our terms, a kind of little Brighton unicorn story. And it would go big. Sorry?
Ponycorn.
Ponycorn, is that right? Is that what it is? Ponycorn. Oh. Okay, that makes sense. Yeah, and I don't know what others think, but the kind of emotional feeling of you're going to get diluted and give the gains to somebody else didn't sit with me. I know you can cash out, but I didn't want to.
Yeah, and I guess part of that's because you had such conviction in this company, and we talked about this before. And you mentioned something around, you had domain expertise in this, and you had proximity with the founder. So that must have helped you feel much more confident. In
the metrics were clear. One of the things that we always did very clearly was very clear KPIs and metrics, and not just the kind of growth and burn or profit or whatever, but GRR, NRR, customer acquisition costs, lifetime value, all of that. So, and RJ was very familiar with those sorts of things. So I think as we grew and as we got more and more fluent, we could speak about, okay, what are the numbers looking like? So he would say, what's GRR looking like? And I was like, well, it's still, just below 85. And he's like, okay, how are we going to, so there was an element of like really understanding the detail of the numbers. And then I remember talking a lot about, okay, is Google going to come in and decimate your business? And, I didn't know the answer to that question, but my answer was basically it's too small. This market is too small for Google. It's not good. It's not everybody needs this. This is really only B2C brands, and there's a lot. It's not as automatable as Google Analytics. You can't just put a tag on a website. So I was pretty sure that this was something that was just not important enough to be. It wasn't going to be $1 billion in revenues.
At the same time, I was also investing into what we were doing in social media in my company. So we invested £1 million just into building out our team that did the social media work for corporate clients or blue chips. So we were getting a view across it all at the time as well. But just about domain expertise, I mean, we got to get, this is quite a long time ago now. If you go back to 2007-8, we were the domain expertise in terms of the people that were working in the internet then. We were learning it as we went along, and we were making up as we went along. And things like cloud services, and you've got Google Cloud backing the event. Of course, that was only just beginning some of that stuff. I don't know when AWS, when you switched over to cloud.
2017, 16.
Wow. And up to 2000 and...
All our own service.
Wow. So none of us would probably...
1,000 servers behind the scenes.
Wow. So none of us would probably consider that now. If we're looking at an investment and they said they needed a load of infrastructure, we'd say you're mad if you're building it yourself, unless they were doing something seriously offbeat or crypto or something that needed a high level of security. Even that you probably wouldn't believe it. So then domain expertise it needed more leaps of faith. And perhaps now, like the last panel said, there's a lot of things you can look at for read across. and for experience and sharing experience. So I think the Brandwatch story is interesting for angels in that one of the big things that hasn't come out yet from the conversation is that the share classes at Brandwatch were very, very fair and led by Giles all the way through. So he always said to me, even if it was a brief conversation, share's the same as mine. And that's all I needed. If he said that to me, I'd be like, okay. If I'm getting what you're getting, then that puts a lot of trust in. Now, we know that that's not always so common, and a lot of documents that I got through those rounds, some of them are really complicated documents, and some of them are time pressured, and you're on holiday and you've got a big a share agreement to read, and you're not sitting with a lawyer, and it's quite, some of that can be quite stressful and quite again, leaps of faith. Probably I should have done. It worked out okay, but I could have done more due diligence through the processes later, which I didn't do, but it worked out. Yeah.
And actually, just on that, so I mean, clearly, Giles, you were great at raising funding. I mean, you made it sound like it was just really easy and lucky, and obviously the company was fantastic for that time, but you must have been good at raising money, right? Well, maybe Arjo can answer why you were good at raising money.
Yeah, maybe my view on that is that in the early days. I think, as we heard from the previous panel, the angels are buying into the founder and the vision, the idea, and how it's presented. So you're kind of selling yourself at that point, and your conviction and so on is massively important. And as it goes on, depending on how bumpy it is. I think it depends. But by the time you get to professional, VCs and those sorts of guys, it's very metrics driven. Before that, you've got this valuation trough, right? Where in the early days, the company's worth not very much, but you're not going to raise money at whatever 50 grand valuation. So everybody takes a bit of a punt on the valuation, and then the company trades into that, hopefully reasonably quickly. But that's a challenging time. I just had this view that I'd taken money from friends and not family. My family didn't have any money, so didn't get any from them, but from friends. And it mattered a lot to me that they at least got their money back. So I'll work for nothing until we get over the hump of sort of existence, which. After 3 years, we kind of had. Like, by the time we got that Durrance money in, I remember speaking at the Christmas party until the staff saying, look, we're default alive now. This is not going to go anywhere. So it's now a question of where we're going to take it, how big it's going to be, or what we're going to do with it, rather than is it going to be here or not. The risk has declined. So now's our moment to be bold, be brilliant. That was I just said that, and then that became our internal mantra. So it was, that's a slightly different answer to the question. It's not really an answer, but the fundraising, it got not easy as it's not the right description, but it was not as black and white, I guess. We got term sheets all the way through after there was a significant chance that we weren't going to get anything at the beginning, whereas after that it was like once we hit the metrics, well, it's a question of price, really.
Yeah, and just Arjo, I guess on that same point, because I think early stage investors going into a company have huge investment risk. So is that company going to go on and raise the money that they need because they can't get it all from you? So what do you think made, and dilution, yeah. So what do you think made Giles successful at raising funding from your perspective as an investor?
I mean, I'm still attracted to founders that are great on product and great on sales. So assume they check out as a good person, right? Which is a hard test to standardize, obviously. So hopefully you got access to them. Hopefully you press the flesh and you like the cut of their jib. But you do that, and then you want product expertise and you want someone that can sell. And if you add that to integrity, you've got someone that's obviously compelling in a market. So that's what I think Giles was good at, and doing the detail was really important in the area that you were working in, because most people didn't understand it. I was at that first meeting with London Seed Capital with you and that, and I remember, why are we in here? None of these people understand what's going on with the internet. Maybe not one of them, perhaps one. It was that thin on the ground, and so. I think doing the detail with people when they don't fully understand the area is really important. Giles is very good at that. So yeah, that was really important.
Fantastic. And just to round up, so Giles, how has this whole journey of raising money for Brandwatch made you into the angel investor you are today? Because you've been angel investing since you've exited, is that right?
I think I've got over 100 investments, but
You've already got over 100?
Not all direct.
That was fast.
Probably, yeah, exactly. Probably 10 or 12 direct, something like that, of which 3 have gone bust, and I've lost, and they're the ones I put the most into. So really fucking.
Were they your kind of first few?
I put 100 grand into each of them, and they've all gone bust. So, and that's within 2 years. I mean, spectacular. So I'm anti-angel. Like, do what I don't do. So the others are all through funds. So I've invested in, because I realised that I'm too impatient, too optimistic, and too gullible. And so I like give it to professionals, and then limit my own, to maybe 50 or 100 a year rather than just being an idiot. Yeah, I think I'm a terrible investor because I'm a default optimist. I think everything is possible. Yeah. And I also think people will work as hard as me and take it as seriously as I did. Because like when Arjo put his money, like I said, I am not going anywhere until I've made this work and paid it back. It's maybe easy to say in hindsight, but that's how I felt. Yeah. And I don't see that enough in the people that I've invested in, which drives me crazy. So, and like, how do you test for that? I don't think it's hard.
Yeah, that's really interesting. And you obviously the kind of typical route from exiting is to become an angel, but I've heard that from so many people that they're just too impatient to be the angel after that. It does, especially because obviously you had so much success with your company, you almost have that expectation that will happen with your investments.
Well, I mean, I'm just naive. I see the positive qualities in people, and I don't do enough kind of DD. I'm not patient enough to wait and let the other qualities emerge and then make a balanced judgment. So,
well, there is a chance that you're taking more of a VC approach where you're investing in the outliers. So you're going to have loads of failures.
There's
some
a chance.
Really big successes.
There's zero evidence of that at this point.
And Arjo, through this journey, what's kind of the biggest thing you've learned as an angel investor going through the Brandwatch journey that you can leave us with?
I'm really cautious. As an entrepreneur, I had courage. As an angel investor, I don't have the same courage. I mean, the Brandwatch story is one. I mean, I invested into a business that was a retail. I mean, a shop. Who invests into a shop? I did that. I mean, crazy stuff. I mean, I'm more confident running a business than I am investing into it. So similar to some of the things Giles said. It's much better to leave it, for me personally, to leave it to people that do it full time. So again, either via fund, I've got 2 or 3 direct. I wouldn't build that portfolio up to the 10 or 20 or 30 that others have got. Certainly not 100, although using funds and stuff. Yeah. Did I answer the question? I've forgotten your question, sorry. Okay,
so one optimist, one cautious guy.
Cautious, yes, super cautious, super cautious. Got one company I invest in who's in the room, and whilst it's the person and it's the product, the caution is always there. It's always there in my mind. It's like my kids' money is the way I think about it. I'm Indian, hey, that's how we roll.
Fantastic. And we have 1 more minute left, so I just want to ask, if you were taking punts right now, and obviously you're both are not, but if you were, we're going to talk later about what future investors are betting on. You don't actually have to do this, so you can say anything crazy that you want and don't have to put your money on it. What are you most excited about in terms of where you would put your money? What innovation?
I tend to swim in the opposite direction to everybody else because I just think if there's a big hype around something, then valuations are going to go up and you're just getting irrational behavior. So I'd avoid AI at all costs right now, but that's just, I think, maybe really dumb. My daughter's going into biotech stuff, and I just think that the future of that we're all going to live longer. We're going to have probably net a bit more money, and like healthcare is going to get more and more expensive. So I think, like, if I'm thinking long term, I think very risky, but biotech is, I just think, a very, very interesting area.
Great. And Arjo?
That's a tough area to angel into, right? Right. So yeah, okay, I'd agree with that, but I'd go via. I wouldn't, angel into that in a way. I'd buy, I guess, equity shares in that or funds. Gaming I like, only because my son is a mad gamer, and I go to him with the ideas, and he says, never heard of them, don't know the company, because he's just gaming, right? So he doesn't quite check out. But gaming is the new Hollywood and way bigger, and it crosses over into all sorts of other things like crypto and so many other things, and probably healthcare will be delivered, via it at some stage too. Amazon does their way. So yeah.
Fantastic. Thank you so much. A big round of applause for our panelists.